Ladies and gentlemen, welcome to the unnamed podcast, forever and always until we find a name. With me,
podcast.
yeah, with me is the great and powerful Brad, stock market nerd. He's great and powerful. I mean, there's no other way to describe him. And then, as well,
I don't know if you saw on X. He posted how tall he was, 6'4", big and strong.
Yeah, 6'4" minus 9 inches, but close to 6'4", somewhere in that ball.
Yeah. We round up. We're finance guys.
Yeah, exactly.
And Evan, no, you're hiding behind anonymity. I mean, you could be freaking 6'4". You're this tall freak in the audience, and you
5'10", 5'9.5".
I've seen this person with my own eyes. Yeah, that's probably.
I have to.
Yeah, that 5'9.5" is fair. I'll give that to you.
I say 5'10" though. I think that's a fair roundup.
What's your hinge height though?
5'10".
There you go. Okay.
Honest man.
I think I can deliver on that in shoes.
Yeah, I was always 5'8", but now retired.
In my Nike shoes, by the way, which I got at the Robinhood event. So boom, 2 stocks.
I haven't even got them yet.
So I literally waited like 6 to 12 months. Okay, I'm a special type of person. My shoes got really bad, so then I went to Walmart, got $10 shoes, because I was like, I just don't want to go through this whole process. And then they started falling apart, and then someone commented about how bad the shoes look, and then I was like, all right, I got this gift card, I'm just gonna do it, and the shoes are really nice.
Yeah, you're very special, man. You're super special.
Going through this whole process, you're talking about buying shoes.
Yes, exactly. And at some point in there, I ended up with $10 shoes from Walmart.
That's just as hard as going to Nike or something like this and just getting regular shoes. But I didn't even introduce you, Evan, the great and powerful stock market news. I think we should just
say, go into it. I was going to pull us off track anyway. Let's dive into it. Google.
Jump right into Google, away from $10 shoes, into what might be my favorite name to talk about in the Mag 7 right now, because it was so unloved that to see them put up some good numbers makes me very happy. I'm curious your guys' raw thoughts, not just on the numbers, but the market's reaction to the numbers, and overall just your first look at the quarter so far.
Yeah, I think so. Important positioning heading into the quarter. There was several consecutive days of just really positive price action. So it was on a run. And so maybe not the most surprising to see Mr. Market shrug off a positive report after such an aggressive run up for the company. I talked about that a little bit in the earnings season preview I published last week, just how things have gone very far, very quickly. And it might be harder to deliver that kind of explosive sheer upside in the immediate term because of that. Multiples have expanded a lot, risk reward has deteriorated. Even for a cheap name like this, multiples move from, I think, like 16x to 20x. So 4 turns of expansion isn't nothing. So I think that reaction for a long-term investor like myself, something to kind of ignore and not pay much attention to. I think it's just digesting gains. But from the actual numbers, they were very good. And starting with the dying and I guess dinosaur, everyone thinks business, that is search, 2.5% beat versus consensus. Revenue growth accelerated well in excess of easier comp help. So they were comping over growth that was, let me pull that up, about a half point slower, but they accelerated by 2 full points. So that is well in excess of things just being easier in terms of this quarter versus last quarter. And the other thing that was super important is there's been a rising debate on, and we talked about this a little bit, on click growth versus click monetization growth, and how click volume has been maybe not the best for Google over the last several quarters. My argument for that over the last few episodes we've done, or we've talked about Google, is that when you're putting up these AI overviews and AI mode in Gemini, you no longer have people scrolling through the legacy Google search page and clicking on 8 different links and not getting what they want in the first 7, but finally finding that that needle in a haystack on the 8th link. So that you get 8 clicks from that interaction, that customer journey. But when you're matching them with the perfect link the very first time, like they do an AI overview so consistently, at least I've experienced through my own work and my own life, clicks fall. They fall very meaningfully. But what happens at the same time is that those clicks become far more valuable, and they're far more targeted, far more likely to lead to paid conversions. All of the things that these click receivers care about are far better. So CPM, or cost per thousand impressions, go significantly higher because these placements are so much more targeted, because they're so much more accurate, because they work so much better. So I've argued, and the company's argued, that click volume growth is not something to pay much attention to because AI is becoming such a larger portion of their search business than it was a year ago, and you're comping over that change. But we don't even have to really talk about that or worry about that very much, because paid click growth accelerated by 2 full points quarter over quarter from 2% to 4%, which is very good in the context of this transition to AI, which has been a massive click volume headwind. So search, very, very good. They reiterated that 10% engagement uplift that they've found from AI overviews, and they've added that uplift is only building over time, so it gets better and better. And ChatGPT, I mean, no company has taken more than 10% share of search. No company's really come all that close. So if these searchers are giving you 10% more volume and you're ceding less than 10% of market share, I think it's pretty safe to argue that AI has been a net tailwind for this search business. And you can really see that playing out in stable, very consistent growth throughout basically the last 2 years. I mean, it's been right around 10% to 12%, and again, right back to 12% last quarter. So that's very good. YouTube, excellent. So we talked, maybe, I don't know if we talked about this last week, but Netflix is kind of seeing their market share in streaming stagnate. It's been about 2 years of that, right around, I think maybe 9.5%. I don't have the exact number off the top of my head, but during that time, no one's really taking much share. Amazon Prime's taking a little bit, Apple's taking a little bit, but both from very, very small bases, so not super noticeable. And then here you have King YouTube going from 9.9% market share to 12.8% market share year over year, just absolutely killing it, while YouTube Shorts, which has been growing like crazy, is now monetizing at the exact same rate as all other content consumed on YouTube. And so as YouTube Shorts becomes
That was, for me, that was a pretty meaningful statement. That one specifically was one I was going to bring up.
And you're so right, because YouTube Shorts is going to become a larger and larger percentage of total hours and content consumed on YouTube over the coming years. I think that is inevitable. I think that's obvious. I don't think anyone would argue with that statement. So if you want this monetization engine, if you want advertising growth to stay very strong for this gem of a company, you need Shorts to monetize effectively. And that was a risk over last year that's now kind of going away. So YouTube amazing, search amazing. Now let's talk about cloud for a second, and then I'll stop blabbering and pass it over to everyone else and not take everything that everyone probably wants to talk about. But the cloud business, I'm just going to give 2 stats, but beyond the growth acceleration, that was fantastic. Before the OpenAI contracts that they've just landed are kicking in, just 2 things that I want to say. So $250 million deals doubled year over year. And the amount of $1 million deals that the cloud business has signed so far in 2025 has already surpassed 2024. So full year 2024, about 7 months of 2025, we're already past it. The backlog is absolutely rocking. And the one thing that you can pick on for Alphabet for this quarter is them raising their CapEx guide from 75 billion to 85 billion. But I'm not willing to pick on that, because when you dig into why that happened, it's because short-lived assets, they need way more of them. There's way more compute demand than they expected for their cloud business. So they are leaning into near-term demand signals and spending more money to take advantage of these signals. So you can say, well, they should always be trying to maximize free cash flow in a given quarter. That's a very short-sighted public market opinion in my mind. They should not be trying to optimize free cash flow when they have a fortress balance sheet and can still print $5 billion in free cash in a quarter when they're spending like crazy on CapEx. They should be raising the Gen AI value creation ceiling over the next several years, which requires spending $10 billion more on CapEx. So would I have loved to see free cash flow at $20 billion that last quarter? Absolutely. But do I think that this is the correct decision in terms of maximizing shareholder value creation for a very long time? Absolutely. So big 3 businesses, all absolutely killing it. We can get into network and Waymo if you guys want to, but I'll pass it to you guys for now.
No, I mean, I think you summed it up really well. It was in my opinion, it was a home run across the board, and the big bear cases got deleted. But I'm curious what the remaining bear cases that analysts are still putting up. I actually wouldn't know what it is. I know a lot of people pointed to just capital expenditures increasing in general, but I think that the long, if you want to call it AI race, whatever, they're going to have to spend a lot to stay in, and I actually didn't mind it. My hedge there is NVIDIA as a larger percentage of my portfolio, so I didn't mind seeing that at all. But I would like to know what are the bearish cases now?
Yeah, you NVIDIA and AMD shareholders should be very excited about CapEx commentary from companies so far, and what Meta's talked about with 5 gigawatt data centers being built next. But I think the perceived risk for this company, and I don't think it's that big of a threat for their financial engine, and I'll explain that in a second, but I think it's antitrust. and especially ad tech on the ad tech side, where their network business attempts to be, despite the fact that they own a lot of these impressions, they are attempting to match the supply side and the demand side. So match advertising demand with the highest and best value impressions for those advertisers. And that's an inherent conflict of interest when you have the option of placing those advertisers with your search impressions, with your YouTube impressions, across your other properties. And they make more money in that transaction than if they're placing this random impression with CNBC or something like that. So there have been complaints, and very real complaints, about Google placing these impressions with their own properties instead of the highest return on ad spend opportunities for these ad buyers. And I think that's something to focus on. But why this doesn't matter is because they talk about, I think it's been maybe a few years now, they're when they talk about their network business or DV360, that's really what they're getting at in being that conduit between the buy side and the sell side for placing advertising on digital properties. And they are rapidly deprioritizing focus on that business. I mean, the network business has not grown for a very long time, and they don't, pardon my French, they do not give a shit about this business. They care about making sure that YouTube's ad business in isolation is thriving, that Google search is ad business in isolation is thriving, that Gemini's eventually will be thriving. That is what they are focused on. So to me, it's antitrust. But if you want to say, okay, you have to sell your network business, I don't think we will see any material impact whatsoever at all in their financials the following quarter, because they just don't care about this at all, and they are more than happy to watch it shrivel to zero. I think, and then the other thing that they might be forced to sell is Chrome, which I do think would be actually more damaging to the overall value prop, just because it's got such massive distribution, which that distribution just means great browsing level data to feed all these Gemini models, to inform faster model improvements, to tell them what people want in terms of product innovation. So the full stack AI approach that Google has, a big part of that is distribution, and owning a large portion of the browsing market is part of that distribution. Now they'll still have 6 other products that have 2 billion users, so not the end of the world. But that would be one that I don't view in a positive light. It wouldn't make me freak out or panic or anything like that. But it would be a negative for that company, and I think it's something to pay attention to for sure.
Evan, first thoughts as well?
You know, the argument for Google a while is it's been lagging behind the Magnificent Seven over the last couple months. I'm talking about the stock price here, and over the last couple weeks or so, it's come back pretty aggressively. So I wish we were at a point of 2 weeks ago coming into these earnings, because then that would have been a plus 10 to 15% move. I think a lot of what we saw there. Yeah,
Google's been like a pretty central theme of this show for the last 2 months, and we've been pretty.
I've been trading it. It's been fun.
Pat, I think we can take a little bit of credit for that. I mean, not a lot of credit, but just a tiny bit. Is that okay?
For me, I always take 5% credit of everything if it's given. The statement that I really was gravitating towards was the YouTube Shorts one, being able to monetize at the same rate. I know when I was following the track of Meta and kind of their switch over from the in video feed over to the Reels content, and once they were able to get to that point, it was a pretty large milestone. So that was something I was pretty focused on. I was dunked on and corrected about having 2 billion monthly active users of
I
of the
destroyed
AI
him and put him in his
overviews.
place.
100%. Tweet deleted instantly.
Yeah.
So that was a good one. Although what I found very interesting on tweet deleted, gone.
Absolutely dunked on.
Yeah. But yeah, I lost my train of thought.
You were talking about Google's AI overviews?
Yeah, that's what it was. Okay, the search business, people thought it was going to go away forever, and what they really stressed on this call is the search business is changing. It's evolving very quickly. We are doing Google Lens. We are doing AI overview. They are innovating very quickly in this space. And although it might go down from 90, 80, 70% of that market share, and probably in the shorter term, given that these AI overviews and a lot of these other things are probably more expensive right now than just typing something into the Google search. There's just more cost in that business, the GPUs. Shout out Jensen getting some of those costs. But eventually that's going to come down, and this will get to a point where the business mechanics are probably going to be similar, shaken up, and Google's still probably going to be the dominant player.
Yeah, and I mean, if you the sell side data we've seen that I at least I have access to, with, I mean, Sensor Tower data on Gemini downloads, survey level data. I think it was Piper Sandler. It might have been a different firm, about intent from young users of switching away from Google to ChatGPT has tanked over the last few months. So I think, I mean, they have better data than everybody else. They have better models than everybody else. So it makes sense that if we're still, I mean, if even people who have replaced some search use cases with ChatGPT or Perplexity, or any of these other chatbots, Grok, whatever you want to call it, they're still going to Google sometimes. They're still seeing the changes that are happening on that page, and they're still typing in something into a Google search bar, and now more frequently getting an AI overview that does basically what they want from other chatbots. So I think that the fact that product parity has been reached, and I think best in class product status has been reached for Google. I think that's a subjective opinion, and others would disagree with me, but just using all the products, that's kind of how I feel. It does make sense that this initial engagement success that ChatGPT has enjoyed is starting to, they're still killing it. They're still growing like crazy, but Gemini is also now killing it, and Gemini is also growing like crazy right now. So yeah, I think we talked a lot about how over the last few months, again, about how these market share losses for Google are probably just a byproduct of Gen AI creating massively more search use cases and more valuable, more utility rich search use cases, whatever I'm trying to say. So creating new share, creating new market share, and when you have 100% of market share and these other companies come and start having any kind of success at all, that will look like market share losses. So again, that 10% engagement uplift I keep talking about for AI overviews, to me, is just such an important KPI for determining if this is a net tailwind or a net threat. And right now, to me, it's saying net tailwind, and we have reason to believe that that's only becoming more true with the recent download data we've seen from Gemini.
Yeah, I'm very positive on it. I think that the thing that I'm most excited about for Google is just the pricing of the company is still priced as if, it's one of the cheapest names in the Mag 7. We're seeing, hopefully, a return of a little bit of confidence in the stock, but I actually think that will continue over the next little bit.
By the way, I'm sorry
curious
for
what
that. I
you're
just
showing
threw
us
this up
here.
on the screen. I was just like, I thought this was really cool. This was like that Perplexity browser. And I found out that you can like literally just ask it to go through and put on indicators for your charts and stuff. So I'm going to do it and see what the AI says about Google stock here, if it's bullish or bearish.
Technically,
Yeah, it's literally just putting this on there now. So we'll see what it says. Your chat's also pretty funny. Someone asked why I didn't show my anything, and then there was a comment about eyebrows and facial hair, and then it came to Evan doesn't show his face because he can't grow facial hair. Dookie Pie is a funny guy.
Yeah, I definitely have some thick eyebrows. That's for sure.
Doogie Pie's actually a girl in chat.
Really?
Yeah.
She's funny then. Honestly, I did laugh. That's why I brought it up.
But yeah, I mean, I'm interested to see this a little bit, but I also want to get into some Tesla talk whenever.
I'm ready. I'll shut up and see what this ends up saying here. I
Tanner,
thought that
do you want to pull it back up whenever it's finished?
Yeah.
Tanner, I feel like I saw a lot of the big points for Google. Do you want to go first on Tesla?
No, I mean, I was pretty freaking disappointed in Tesla. The call was, I mean, a little bit embarrassing. Like, why do I have to take this one? I'm gonna get cut by the cult.
Energy business gross margin was phenomenal. So there you go. Starting off on a positive note.
There you go. I think that if you're talking about Tesla diners and Grok before you're bringing up Optimus in the call, it's a little bit. He's talking about Grok. Why are we talking about Grok on the Tesla earnings call?
And then refusing to answer another question about XAI in the Q&A after they talked about Grok. I was like, well, you guys already brought this up, so why are you mad at the analyst for asking you about it? But
yeah, the CFO said, "Oh, sorry, I'll butt in and take this. We're actually not going to talk about this." And then you could tell Elon wanted to talk about it, but I don't know. I'm not happy with Tesla. I want to be a shareholder of that business. I mean, we were talking about the name future investing before. I think that somewhere in that I would like to have Tesla, but the valuation does not meet the disappointing earnings. In no way can people get excited. And it seems like the transitional period for Tesla continues to get extended. And now, I think Elon said they're going to have brutal numbers through all the way till Q1, and then things will start to perk up. I don't even know if
Could we? So does that mean we will have a few rough quarters? Yeah, we probably could have a few rough quarters. I mean, he said it so monotone and bluntly. I'm like, damn, that's definitely candid from him. I thought that was like, never mind. Sorry, go ahead. I keep interrupting.
No, I appreciate that. It's just how many times can comments about being the largest company in the world by a large margin cloud what we're actually seeing in the numbers here? Obviously, Robotaxi is going to come online, but are people believing these timelines of you're going to be in not in the hands of half the population, but in areas that consist of half the population of the US by the end of the year? I don't see a single road to that at all. We haven't even seen one autonomous ride without safety drivers in it with another human in it. So I want to be a shareholder. I'm disappointed. Happy I got out. Happy I bought NVIDIA. And yeah, the market is reflecting its uncertainty and lack of confidence in Tesla currently selling off. Well, I mean, we're saying that it's still like above 300. I think it closed at, but yeah.
Yeah. And so I think a lot of people want to say it's macro, like rates are too high. And I'll just point out that although their margins are putrid compared to Tesla, Lucid and Rivian are delivering year-over-year growth this year in their auto business. And I know Tesla is way further along in its growth curve and more mature, and that means they're more susceptible to macro than a company that's brand new and taking market share. But I mean, this is the leader. This is the clear leader in electronic vehicles. This is the company that's done more to advance EVs than any other company on the planet. So I think they'd want to be delivering year-over-year revenue growth, at least 2-year compounded revenue growth, when their competitors are. I mean, it's we've had 2 years now of. I mean, I'm looking at these numbers. They comped over 2% year-over-year revenue growth last year and delivered negative 12% revenue growth this quarter. I mean, and you can say incentives and tariffs and all of these things, but then you look at market share charts and all of these macro headwinds. The exogenous backdrop is largely the same for all of these companies. So if you are losing market share, it is not just macro. It is more than that. It is the company. Do I think it's because Tesla's cars now suddenly stink and everyone else's are amazing? No. I mean, Model Y is an incredible car.
Yeah.
Tesla is by far the best EV I've personally ever been. I've only been in 2, so by far it's one of 2. So the Rivian truck and then the Model Y. But the Model Y is a fantastic car. It's very fun to drive. So then you think about, okay, is it the politics and the fact that he's kind of maybe polarize some audiences in the United States and Europe? Maybe. Is it the fact that, like Tanner was talking about, he's focusing on diners and the America Party and XAI and Grok and all of these things, and maybe not prioritizing this great American company he's built? Maybe. It's something, because market share trend, I'm just looking at this chart that they shared. This is their data that they're sharing. Market share growth has not been positive since Q3 of 2023 in any of their major markets, North America, Europe, China. So negative in all 3 of those markets. And then again, they're talking about the removal of the EV tax credit, $7,500, leading to, like Tanner said, a few bad quarters coming. Talking about Optimus version 2, which was supposed to have thousands of units deployed by the end of this year. Now there are design flaws that this is the first I'm hearing about it. Maybe they talked to some analysts privately about it. But now that's not going to happen until Optimus 3 and next year. Yep. The affordable mass market car is now delayed for another quarter. They're talking about covering Robotaxi 50% of the population, but they were so careful every time they said that to say pending regulatory approval, which to me means, okay, that's what you think should happen, but bureaucracy doesn't move at your pace, and we'll see what kind of red tape gets in the way of making that happen. But you're paying 200 times forward earnings for a company whose core business is in decline, for a company where the products that are supposed to replace the financial drivers from this core engine are now being pushed back, where I don't know. You are banking on the future to create massive shareholder value when the market cap is trading like that massive shareholder value has already been created. So, an amazing American company. Elon is fantastic at building hardware. You are now reliant on him being right about his timelines for all these disruptive products coming to market because their core business is not delivering anything remotely close to something that deserves 200 times forward earnings. So, can this work out? I'm sure people have had conversations like this in the past on Tesla 5-10 years ago, and they've proven the doubters wrong, and they've been doing that for a very long time. And again, they do make great products, but they have so much proving left to do. And when you have all of that proving left to do at this forward valuation, I just look at it and go, why would I spend my time here when I could spend it on something else?
There is a lot of other companies that are extremely fast growing, high margin businesses at much lower valuations that aren't, potentially hated from both sides of the aisle in terms of if you are trying to get regulation through and pass, so then you can roll out robo-taxi and Optimus and all of these things. I don't know. The person that's going to get you that permits is not a big fan of you right now.
Yeah.
It just makes
The
a hard
great
combination.
irony, the great irony of all of this is he is the one who helped him get elected. Maybe he's even the one. Some could argue that's the reason he got elected. Maybe it was the difference. I don't know.
Yeah.
I think there's an easy argument to make there. I think he
Yep.
had a massive influence on the election last year.
Yeah. And last thing, Evan, is just I thought it was pretty freaking sad to watch them say, hey, you know what? EV credits are expiring soon. Make sure that you go out and buy a car. Like doing a car commercial mid like live earnings call to their own shareholders was crazy to me.
I think we should offer the caveat that we're talking negatively about past performance. I don't short, but if I did short companies, this would not even come close to something that I would consider shorting.
Correct.
Just because Elon is so freaking amazing at just cultivating shareholder passion and interest. He is so good at eventually delivering on his promises. Timelines uncertain, and I just think if you do short companies, which again I'm long only, so I don't bet against companies, but this is just not one. This is not one to focus on. I mean, there have been brilliant short sellers and investors rightfully calling this expensive for 15 years, and it has delivered massive shareholder returns from then to now. So I just think this isn't the too hard pile. I think if I had to pick between owning shares or shorting shares, it would be a tough decision, but I pick owning shares. But I don't think either of those decisions right now is something that I'm at all tempted by. So
if I could pick Tesla or cash, I would pick Tesla.
Yeah.
But I don't have to pick cash. I can pick other companies that are a lot less hard to break down and understand the bull side.
Actually, I don't know. 4% return right now versus what this could be. Versus 4 bad quarters coming up, according to their charismatic CEO. Maybe I would pick cash for a few quarters and then hopefully wait for the dust to settle and move over. But
I think Elon brought up a good point. Like a lot of this is just stake. He has amazing other businesses that take a lot of his time that he has a much higher equity stake in. And Tesla, for a large part, I mean, it is $1 trillion company right now. It'll take some time to get to 2-3 trillion. I think people will think that comes very soon, but I think it's actually a lot higher chance for him to go to XAI and triple that valuation. And he has a very large stake in these types of businesses. So I think for him, he's just sort of drained on this company, especially for the next couple of quarters where he knows it's going to be extremely hard. I don't expect him there too often.
Yeah, I mean, he's building tunnels that are creating great routes from city to city. He's launching rockets. He's building X. He's building Grok. He's got so many things going on right now that expecting him to be a full-time CEO during a point in time when I think a full-time CEO is especially important as his industry shifts and moves and evolves as quickly as it currently is. I think that's fair to want him to be solely focused on this company. If
I could give Elon the biggest flowers, though, and you could tell me if I'm wrong, I can't think of a time, but you see a lot of brain share or top talent end up going from Microsoft to Google to Microsoft, OpenAI to Meta. The fight for top talent is insane. I have not heard a lot of stories of top talent going from or away from Tesla or over to XAI in quite a while. And his ability to captivate young, extremely smart talent, like he knows how to drive a mission through. Yeah. Obviously, one man only has 24 hours in a day. So he's not he's pretty superhuman, but he's not finding extra time. He needs to be able to find talent to leverage his time. And I think he might be the greatest person in the world at doing that.
And it's the disruptive, like screw the norms, like I want to break things and change this. It's like that kind of talent that he's captivating, which I think when you're trying to disrupt the entire global economy with AI and infuse it in every facet, I think that's the kind of talent that you want. The off the beaten path, the not clean cut, like I'm going to work my ass off, try to break things and try to just create
mission driven.
Yeah, mission. I think he has a bench of talent full of people like that who have that crazy hungry founder mentality who make up his AI research teams. And it's because of him. So I've said a lot of not super positive things about the Tesla current fundamentals, but he's still a fantastic CEO. He's still gotten them to this point. So it makes sense that he's still delivering on these world-class teams and keeping them while Meta's stealing. I mean, OpenAI talent, 3 more Google researchers yesterday, left and right. And I think the other interesting thing is we talked about Google raised their CapEx guide from 75 to 85 billion. Tesla lowered theirs from, I think it was more than I should pull this up and not get the number.
They said more than 10 billion in the past, and this one they said 9 billion. It was that, right. Yeah,
10 plus to 9. So that was maybe it's timing and orders for certain hardware is being delayed to 2026, so they'll spend more next year. But that was very interesting. I was not expecting to hear that. But for the AMD NVIDIA read through, that's $1 billion, and you get plus 10 billion from Google. So so far so good on
net 9, baby.
Yeah, net 9, pretty good.
Evan.
Yeah, Elon did put a clock on some of the conversations, talking about wanting to get up to the 25% voting control, kind of using that November meeting as maybe putting a point to that one. And they should also get the ruling around his Delaware shares. I didn't hear exactly when, but I don't think that was actually too far away, the final ruling on that one. So, I believe that will happen before the September-ish proxy vote goes out. So I would look at that. We'll see. I don't know what happens if Elon doesn't get up to that. Yeah, what I will say is you're right on the numbers. It's hard to look at that and say, yeah, here's why it's good, here's why it's whatever. For the people who want to be excited about, what I think you can be excited about is this thing that you've been waiting for so long is finally here. The fact that there are Teslas on the road being driven, whatever, safety monitor, what is their thumb doing on that thing? Who knows? Like, you know what I mean? But it's there. It's on the street. Waymo is showing that this is real. I also want to say that if you look at where self-driving cars are available right now, there are 70, 20, 30, 40 cities in China, and there's like 5 in the US, 2 companies doing it. Like this self-driving thing is here now. Again, it's an example of real world AI. It's how quickly is a lot of that stuff going to come. I think that Elon is this is part of the reason he hates being a public company. He's a great technologist. Who knows if he's the best CEO out there? Maybe there's a world where like if Elon was like the chief technology officer and someone else was the CEO, maybe that's the way it goes. Maybe you don't kind of say you're going to bet you say you don't care about the EV business anymore before your next business is actually here and ready to go, you know? So I think it could be part of that. But when I think about my time frame as a 10 whatever decade plus investor who's willing to give up what probably could be a 2 to 3 years sideways year for the scale of the opportunity with self-driving cars, I don't even think you need to put Optimus in it. Yeah, so I think that tough earnings call, tough numbers, probably gonna be a tough next couple quarters. That tends to get priced in before it happens. So, you know, if in 6 months from right now, we know the next quarter is going to be bad, but you hear, hey, this is actually happening now, the revenue that's coming in on it, I think that could turn around quick. And when you're going for step changes, it doesn't happen incrementally like some other businesses do. It can a lot of the times be nothing and then everything all at once. And the stock market isn't always ready to be valued at that way. So yeah, this is probably going to be a sideways stock for a good amount of time until it's not, and then until it's not. And if my thesis is right, it's going to be aggressively higher. I wonder how many quarters they give it. If Tesla has to come in and use lidar, that would be about as big of a blow as possible. That would take away a lot of the edge. So maybe that's it, but
I don't know.
I
I
don't
think
know.
models are advancing. I'm sure they'll be able to do it the way that they're currently doing it. Our own eyes are making driving decisions right now. But I just don't even, I'm losing hope on
What's
what the
that
end
worth
game
today?
is on robotaxi in general. I mean, what is the rate that they charge? What is your take rate after you're offering this as an Airbnb service? So you're taking a percentage of that for someone else's car because they obviously need to make money as well. The total world TAM for
He
ride
was saying
share,
he was saying they want to
taxi,
get the cost
transportation.
down to 30 cents per mile was their goal, which he was kind of talking about on the call that, like, listen, when we make this car for you, we want it to be fast, we want it to be whatever. When it's a robo taxi, it's different. So I'm sure there's some inherent stuff that's going to built in the price structure and then it has to go down, but that's where he wants to get it down to 30 cents per mile. I don't know exactly. Let me look exactly what the number is now.
I think you could say also like take rate for people owning the cars, putting them in the fleet, similar to Uber, and then they have to pay a driver, and then they take the rest of the pie. But I think
Yeah, but
I'm talking
Uber's
about
not a
cost.
$1 trillion company.
no, it is not. No, it is not. And Uber's
Yeah,
the
but what if Uber didn't have the driver and still had the same platform? What would that be worth?
Yeah, but
well,
with
I mean, Uber's not going to own. Well, they are going to own some of the cars in the beginning, but Uber's still going to have to pay May Mobility and AV Ride and all these other companies for access to their hardware because they're not going to want to own all these fleets. So I don't think unit economics are going to be all that different between, which is weird to say because there's no driver to pay, but there's a corporation to pay, and this corporation has better bargaining power than any driver in their network. So I think it'll be somewhat similar, but utilization rate for cars will be higher too. So more fixed
Doesn't
costs.
that sound like a company you want to own though? I mean, maybe you want to wait until they get closer to it. That I get, but
I think
If Google spun off Waymo, I would be very interested in owning it. You are correct. Yeah.
a company that I would want to fully own if I was looking at this as buying a full business, Tesla looks like a great business. But I still have to price in what the future or what other investors are making me pay for this today.
Yeah.
Like
That's the issue.
And currently, the price of these rides are like $6.90. It'll probably continue to rise as time goes on, but how high does it go? Because it's not going to get higher than human drivers. I actually think Waymo's pricing is going to go down. I think the reason why they're able to charge as much as they want right now is because it's still sort of vanity and people look at it as almost like a roller coaster ride, something to try that's new. But
Totally agree.
once that is over, the benefit of Waymo is the ability that you have your privacy, but you also have lowered costs and no tipping a human driver and these sort of things that make that platform much better than just ordering an Uber. But like, I just don't understand the total TAM. Brad said this, I think, the first episode. This is the epitome of a commodity is getting into a car that safely takes you from point A to point B. If Waymo can do it, other platforms are going to be able to do it. We're seeing NVIDIA's drive platform getting on more customers over and over and over. Like, this will be done by every auto manufacturer. And that's not only to talk about the benefits of Uber and having that connected, space, but we're paying $1 trillion for something that hopefully happens.
Yeah.
And then before...
To your point, there are 5 deployments not named Waymo and Tesla that are happening with Uber through 2026. So there are many there. Yeah, sorry. It's already fragmented. So people thinking this is a two-way race between Tesla and Waymo, that is wrong. There are many well-funded players that are partnering with NVIDIA to collect physical data more cheaply, that are partnering with Uber to help them pay for their cars and to make sure they have fleets and managed fleets that are tapping into capital markets and receiving large sums of funding because there is so much hype in this space. So many of those companies will fall on their butts and fail, but there are going to be way more than 2 winners, in my humble opinion. So,
yeah.
Sorry, go ahead.
And if we do need LiDAR, then the whole case of hardware 3 and hardware 4 was enough. Then that's going to be a massive blow.
Yeah,
that means their entire fleet. Which, by the way, why is no one putting emphasis on this either? Is like the whole idea is that robotaxi will be a multiple of the fleet that's outstanding. But if car sales drop down, that does slow the projections that were made 5 years ago was that they were going to have X amount of cars, by 2025, 26. But now they're missing those targets. So that means less robotaxis. And we're just not seeing the change in stock. I mean, I don't know. I'm being way too critical on Tesla. Obviously, I know that there's people that are very bullish, but I'm just telling you guys the way that I'm feeling right now. Let's talk about Honeywell.
Or maybe quick throwing a nugget for the bulls as well. You guys did enjoy 20% sequential growth in test drives, so that might signal kind of a leading indicator for interest and demand kind of picking up a little bit, which is super important for this company right now, obviously. So that was something that made my ears perk up a little bit and was good news for you guys. So hopefully that is the sign of more things to come and a sign of a fantastic acceleration where we can fast forward a year and you guys are all like neener. I told you so when we hire. So that's what we want to happen. We just kind of offer our opinions exactly how we think of them in our head instead of sugarcoating or anything like that. But rest assured, we want all of your stocks to go up. My newsletter does better when that happens. So yeah.
Tesla Diner eventually turns into a robo-taxi service that delivers food to people without a person in it. I mean, there's things to love on Tesla. I'm not like, that's what's so lovable about Tesla is like just you can let your imagination ride whenever you freaking say, hey, we have a car company, this restaurant business, where the robots are making the food and then delivering. Like you can just keep this is the only company you need in the whole world. Yeah, McDonald's is in trouble, that's for sure. So if there's one company that Brad would short, it's McDonald's.
I did see you also had the McDonald's coffee there, if I'm not wrong.
I do. McCafe is where it's at, but that's the only thing that they get from me. And the occasional beef patty. But
I mean, if you're not, does Canada? I think it's just the USA. Like if you buy a Big Mac here, you're getting way more chemicals and additives and dyes than literally anywhere else. Like Gatorade, Big Mac. I've seen we're getting way off the cuff, but there are probably some things in the United States that should be illegal, just like they are everywhere else in terms of ingredients. But I'm not ingredient market nerd. I am stock market nerd. So I'm just a wee lad when it comes to my ingredient science knowledge. So back to stocks.
I don't know what's in the I don't get any of the bunt, dude. If you saw the way I eat at McDonald's, you're bringing me off topic here a little bit, but if I go to McDonald's, I'll just order patties, beef patties. That's it. It's the only thing I feel like is safe to eat on the menu.
Macros are good.
Yep, with a coffee.
Black coffee and beef. That sounds like
black coffee and beef.
Breakfast of champions. Yeah.
Yeah. Evan, for real, can you give me the 2 minutes on Honeywell? You made me buy this thing. What's going on?
Yeah. No, I listen. I am a fan of the Honeywell. The reason I want to be in this one, we could talk about it. The real kind of thesis around it is the company splitting itself into multiple parts second half of next year. That's one of the parts of it. And then when you look at the segments that this company is playing in, I think that those segments in its own way will end up being worth more than they are currently right now. Some of the areas that they ended up having right now, let me pull it up in front of me. I'm sorry. I know the stock was down. I didn't end up looking how it was. The numbers came in above expectations.
Quantum computing.
They also ended up raising their full year guidance, but it was kind of one of those ones where we just raised the bottom end of it. Here's the thing I was looking for.
That counts.
Midpoint. Yeah, it kind of counts.
Oh, that totally counts. No, you can say that counts for sure.
Their aerospace technology segment was the one part of it that really came in with a miss, but most of their other segments was strong. Building automation, energy and sustainability solutions, or the three kind of segments that they ended up breaking out there. Energy and sustainable solutions. This really what Tesla should have focused in on their call a lot more around all these AI data center build outs, and we need more power. We need more energy. We need more ways to also maintain that grid as well. So that's one of the parts that actually performed pretty well, came in above expectations. And yeah, I think that the numbers you saw today across the board were pretty solid. Each of the segments were doing pretty good. Aerospace technologies, the backlog grew 16% from the previous year in that area. The building automation, the orders grew both year over year and sequentially, led by strength in products, is what this is saying here.
Okay,
But
bro, buy more or sell what I got.
oh, I think 100%. Like I said, the thesis for this one is at end of second year, as this company splits off, they're even doing a lot more strategic opportunities. To me, this is more of a looking at the numbers, making sure it is kind of continuing that growth rates. A lot of the companies you're talking about are 10, 20, 40, whatever percent growth rates. This is a single digit growth rate company. You want to see it maintain that, not go down. You want to see the segments that you enjoy. And I think that you should dig into it yourself and find, hey, which is there one of these 3 or 4 companies that they're going to split off into that I like more, that I want to go into? For me, I'm a fan of the aerospace side of it. For me, that segment, although it did miss today, is still performing pretty strong. And yeah, so listen, I think this is the second half of the year, next year theme. These boring old, well-diversified tech names have been performing pretty strong in that market. So I think that's kind of what this last move has been.
The year of Honeywell, Oracle, and IBM.
Yeah, exactly. Although IBM did fall off. So,
oh, did it? I'm sorry.
Wait, did it? Let's see. It did yesterday.
I don't watch it.
Yeah, it's now done 7% off the week. But yeah, it's been that type of year. I think that's what this move is now. What I'm really saying here is the numbers that we got today change nothing in the thesis. And I'm still a fan of it. And I think that you get that run up going into next year as it gets closer. So a little early. Maybe get some good play in here. You can look into it deeper if you want to really get it for what the company is now. But I'm in it for what the company is splitting, and the pieces are still strong.
I said this jokingly, but if you are a believer in the future of quantum computing and you don't want an ridiculously high beta speculative name, pure play, Honeywell, Alphabet, IBM, like there are big companies that are investing pretty heavily in the space. So I think just a more boring button up, low beta way to gain exposure if you want. And if you don't, then you're like me.
Brad asked us to wrap up in a very natural way. So ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But bye for now.
That was funny.